Hi there, this is Charlie Jewett, industry whistleblower, author, and podcast host, and I'm going to be bringing you today education on the second piece of In-Crease Accounts. So let's jump over here. Now, the reason I broke In-Crease Accounts up into two pieces, besides the fact that it's just a big body of data that you need to study, it's a lot of education, is because really you do have two different types of money. When you've saved up money in accounts, or you've saved up a nest egg, it's either qualified or non-qualified. It's either pre-tax, where no matter where you invest it, if you take money out of it in the form of income or distributions, you have to pay taxes to the IRS. So you're in business with the IRS, and every year they vote on how much of your profits they get to keep, and there's not much you can do about that. You have to share the money with them. That was the arrangement. So it's either qualified pre-tax money, and that was the In-Crease Accounts Part 1 video that I did. It's about 50 minutes long. You can go watch that one. This is for non-qualified money or after-tax money. Now, little caveat, Roth IRAs technically are a qualified plan. They're qualified with the IRS, but it actually fits in the after-tax category of what I'm going to be teaching today, so I just brought that one over. But we're talking about money that you don't have to share with the IRS. So if you have $300,000 in a brokerage account that's invested in mutual funds, but it's not an IRA, it's not a 401k or an IRA or anything like that, that's the type of money we're talking about. Also, if you have a bunch of money in checking and savings from the sale of a piece of real estate, or you just happen to, accumulate a lot of money there and don't want it in the market, whatever it is, this is non-IRA, non-401k, non-403b, non-457. It's after-tax money where you're allowed to do whatever you want to and don't have to share it with the IRS. So we have all the same options as in the previous video in In-Crease Accounts Part 1, except for there's one extra option. So let's review these options real quick. You could put everything into bank products. You can buy, CDs with the money. You could use money markets. You could leave it all in the bank, just in a checking account. You could put it all in savings and have, basically no interest. At the recording of this video in 2017, the banks are paying under 1%. It's not right or wrong, it just is. It's just the market conditions. It's like weather. It's like weather conditions. So the banks don't pay very much, so you could put all your money in the banks and not even keep up with inflation. That's one option. You could go to the market, which is what most people do. They put the money in stocks, bonds, and mutual funds. There's a good article on mutual funds talking about all the incredible fees inside of them, and how if you have over $50,000, you should not be in mutual funds. For most people anyway. There's going to be a better way to do that, growing your money, putting it at risk, if that's what you want. Mutual funds are a pretty inefficient way to do it. But the market itself is a choice, and that's what most people do, because the advisors who get paid to put your money at risk, those companies spend a ton of money trying to keep you there, and they do not want you to see these other options that I taught you in In-Crease Accounts Part 1, and that I'm going to teach you today in In-Crease Accounts Part 2. So you can put it all in the market, and that's where most people, I've reviewed over 1,000 financial plans, most people, when they hand me their statements, they just have it spread all over the place in the market. It's in stocks, bonds, and mutual funds. You could also use growth annuities, like an indexed annuity. There's absolutely no fees. There's no losses. These insurance companies will take your qualified money or your non-qualified money. So as a review, we talked about this in In-Crease Accounts Part 1. This brown line, or green, brown, or whatever it is, this brown line that you see never going down, just up, 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 or sideways, sideways, up, 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 or sideways, sideways, the ever-increasing line with no fees and no losses, that is an indexed annuity. That's an option. That's been an option for 20 or 30 years. Risk versus reward has not been true for 2 or 3 decades. You do not have to put money at risk ever again unless you choose to, because you find it exciting. If you like to take losses, like happened here in 2000, 2002, 2000, 2001, and you like to take losses like you did in 2008 and 9, and then wait and have recovery, if you like that, if it's emotionally enjoyable, and you're doing it with money that you do not need, there's absolutely nothing wrong with that. Or if you're a day trader and you just know how to time things, that's all fine. If we're talking about safe money that you don't want to lose because you might need it for long-term care expenses, for any expenses in your life, or for leaving as an inheritance, whatever it is, if you don't want to lose it, we need a safe place for it. You certainly can use indexed annuities. If you don't know what those are, you can go back to the previous video, the In-Crease Accounts Part 1, and you can go watch me dig into that deeply. I believe I have an example. in here of the kind of earnings you could receive. Over here in one of those annuities, the lowest time was 4.9. The most recent 10 years, if you were in this particular annuity, was 5.95. And the highest 10 years was 6.83. And this is just one of 3 annuities I covered. The other one, one of the other ones had better returns. One of the other ones had lower returns. I was teaching how to build a portfolio, a completely stockless portfolio without using any products from the stock market at all. So you do have the option of growth annuities for some of the money. It's kind of the bond replacement because bonds aren't doing their job anymore. Bonds aren't paying 4 to 6% safely when interest rates are about to go up or in the process of going up. It's just the reality of the world we live in. So the extra option that's available, and this is my favorite type of money. I mean, I absolutely love this type of money. And sorry, there's an M that's off the recording part of the screen over here that says minimum. But my favorite type of money, and this is where I started my career 12 years ago. I educate on this all the time, all over the country now. I write books, I do podcasts, I do speaking engagements, and this is one of my favorite tools on the planet. It's called the Rich Man's Roth IRA. That's a marketing term. Somebody coined that phrase. Tony Robbins talks about that in his newest book. It's tax-free growth, the way you build it. This is an old E.F. Hutton strategy from the late 70s and 80s. It's been around that long, yet most people have never heard of it. So we're talking 40, 50 years. It's a minimum death benefit, minimum commissions. That's very rare in this industry, and I'll show you. Cash value life insurance policy, or cash value life insurance policy, is built for growth. We're using life insurance for growth. We're using life insurance as a cash accumulation tool. We do not want a big death benefit because that's what costs money inside of life insurance. What we do want is tax-free growth. Life insurance is one of the 3 places, there's only 3 in the world, 3 or on the planet, in our country, I guess. There's only 3 places that you can grow money tax-free: Roth IRAs, municipal bonds, and then life insurance, cash value life insurance. It just so happens life insurance has the highest returns and a whole bundle of cool side effects or sort of side benefits that come along for the ride when you use it the right way. Now, let me show you something that Len Rainier from the Wealth and Wisdom Institute, another educator that I learned tremendously from. Let me show you this presentation that he walks people through. Oh, we've got to go backwards. Nope, that's wrong. We'll do this. Okay. So he has this presentation where we're going to pick and design together right now the perfect investment. So if you're sitting with your advisor who shared this video with you, he could walk you through this. If we were talking, I could walk you through this. You could do it yourself. It's all fine. You can just use this video to walk yourself through it because we're going to do it together and everyone answers the same way. If we were designing the perfect investment together, and you might as well have a bullseye. You don't hit the bullseye every time when you're throwing darts or shooting, doing archery, but you've got to have a bullseye, something you're aiming at in order to get close to it. What's the bullseye? What would be the perfect investment vehicle if you were creating one from scratch? So let's go right over here. Would you want it to have a lot of risk where you could lose your money? Well, for designing the perfect investment, the answer would be no. Okay, guarantees. If it was perfect, would you want it to have some guarantees, guaranteed returns, things like that? The answer is yes for everybody we always ask. Do you want it to have penalties? Everybody says no. Would you like liquidity, use, and control of the money, or do you want it to be tied up? Hey man, we want to be able to use it, right? Right? Protected. Would you want it protected against lawsuits or losses, things like that? Absolutely yes. Be able to leverage the small amount of money that you actually have to control or maybe earn interest on a larger amount of money or leave more behind when you die, something like that. Some form of leverage? Yes. Would we like tax deferral to postpone taxes? Do you want to pay taxes every single year as you earn the interest like you have to in CDs and bank accounts? No, we don't want it to be taxed as earned. We'd like it to be tax deferred. How about tax-free? Would you like to have completely tax-free growth, tax-free income, tax-free distributions, tax-free death benefit, tax-free everything? Nobody pays taxes ever again, like a Roth, basically. Yeah, that'd be awesome, right? If we can get tax deferral on the front end and make it tax-free, ooh, baby, now we're cooking with gas. What about using it as collateral to borrow? Yeah, that doesn't happen very often, but sure, that'd be nice. Tax deductible payments, why not? What if it came with a disability benefit? Sure, why not throw that in there? What if it came with a maid that cleaned your house every other week? We'd like that too, right? All these are wonderful. Wealth transfers. What if you could transfer a whole bunch of money to loved ones? Basically, you get the idea. If we were developing or designing, starting from scratch and saying, well, what do you want? And you were putting everything you wanted inside of some sort of a cash accumulation tool or an investment, you would want low risk, high guarantees, no penalties, use of the money, you want it to be protected, leverage, tax deferred, tax free, yada, yada, yada. Well, I'm going to teach you about cash value life insurance policies, and this is what actually exists. The characteristics of this tool, when built properly, ding, 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 ding. Can I draw your attention to that? When built properly. I agree with all of the people on the internet who say that life insurance is a crappy investment and has too many expenses. I just disagree with them stopping there and not following up with that and saying the reason they believe that is because they're inept, undereducated, or possibly immoral and haven't gone out and learned how to build it so it doesn't have those expenses. What they should be saying is crappy life insurance policies or good policies that have been designed by a crappy advisor are not good investments and the expenses are too high. You cannot say musicians don't make good money because most musicians don't make good money. I'm talking about anyone that can play an instrument. There are musicians who make great money. Taylor Swift, Billy Joel, right? Elton John, Celine Dion. There's people who are in the music industry that make great money, so you cannot say musicians don't make good money. You could say most musicians don't make good money. I would agree. Most life insurance policies designed, sold, or owned are absolute trash. However, that does not change that what I'm going to teach you is how to make a Taylor Swift, Billy Joel, Elton John style life insurance policy where it has all of these benefits except for you can't get tax deductible payments. You can't deduct your contributions and then take it out tax free. It's one or the other. Just like a Roth IRA, we put after tax money in and you don't get a deduction, but you get everything else that you want. Now, Len Rainier asks a beautiful, amazing, genius question at the end of this, because everybody says the same thing. He says, well, here's what you have: IRAs, mutual funds, homes, CDs, annuities, real estate, and how it lines up with what you want. Why is what you have so different than what you want? Such a good question. I love that question. Why is what you have so different than what you want? And I've grown, and the advisor who shared this video has probably learned the same thing over the years of asking people this. People just don't know that this exists. And frankly, to be very candid, you have to run into an advisor who's willing to minimize the amount of money they make down to 25 to 30% of what they're supposed to make. We have to minimize the commissions to make this work for you. If someone is sharing this video with you, they're probably one of the best advisors in the country and have integrity because they're willing to minimize their commissions to do what's right. We can literally hand you 1 to 2% more rate of return every single year for the rest of your life, and in compound interest, that is a lot of money. So the rich man's Roth IRA, this is a type of life insurance designed for cash accumulation. We don't care about the death benefit. We want it to be minimum death benefit, minimum commissions, which I'll teach you, inside of life insurance so that it grows completely tax-free. Yes, there are expenses, but I will show you how to make those so low that you're actually paying less for the expenses than you would pay in taxes in another choice or another investment. Now, this type of life insurance is typically called indexed universal life is what's used most often. Whole life doesn't make enough returns. I've got the entire 20-year, 30-year look back from a third-party organization showing what whole life makes, and it does not make 7 or 8%. But what I want to show you before I open up the software is this line right here. This brown line is a picture of an indexed annuity, but indexed universal life insurance does the same thing. When the market goes up, you get some of it. There's typically going to be a cap or a participation rate. You get half of the up move, or you get the first 11.5% of the S&P 500. So the S&P 500 could go up more and you get a little bit less. And then it goes up more and you get a little bit less. But in the down years, you never lose a penny. There'll be a little cost of insurance coming out, which I'll show you how to minimize. That's fine. So life insurance isn't going to be flat. There's going to be a small reduction in the down years of the market, but you never lose any money in your account based on market losses. There's just stair-stepping up and up and up and up and up. I have clients now that bought these 10, 12 years ago, and they do exactly what they're supposed to. Okay, so let's switch over to a life insurance illustration. I built one so you guys don't have to look at, at the software. This is just one company of, 40 or 50. You have to pick the right company, the right product. You have to design it properly. Then you have to lower the commissions. I don't care what company it is. There's different companies that have great products. They just need to be built the proper way. And at any given time, there truly is one best product for each person in your state. There's different products available. You're a different age than your neighbor. You're putting in a different amount of money, but there's a way to see which one has the highest upside potential or the highest growth. Now, here's an example of what's very commonly done in this industry. I know, 5 authors who write books on cash value life insurance, and they're amazing authors. They're amazing teachers, and they would probably build it this way for you. You're putting your premiums in over a 5-year period. There's a law since 1988 that if you're putting in, let's say, $250,000 of your portfolio, you can't do it all in the first year or you lose your tax benefits. We have to kind of slow fund these a little bit, even though we normally wouldn't want to. You have to, but it creates tax-free growth that's beating the performance of the market, so it's worth it. There are tools to put money into where you put the money into either an annuity or a structured cash flow tool or something like that. You're buying pensions, basically. There's things you can do to put the $250,000 into somewhere it then comes out once a year for 5 years. So we can certainly still simulate a single premium or you funding the investment all up front. It's not an investment, funding the cash accumulation tool all up front. But what I want you to see is what's very normal inside of an insurance policy like this. You put in $50,000. Let's come all the way over to these 3 columns on the right. There's a death benefit. Now that death benefit is a minimum death benefit. We really don't even want that. If you go back far enough, the E.F. Hutton Company was having people buy really small death benefits, 100,000, 50,000. Now there's also rules today that say there's a minimum that you have to buy. This is the minimum death benefit required by the IRS down to the dollar. The software will solve for you. It'll solve for me, for your advisor. It'll tell them what to do. Now every dollar above this, there's more commissions. That's why you don't see a lot of policies designed properly, because the agent has to be minimizing their commissions to do what's best for you. And then I'm going to show you a step further where they have to take away, 75 to 80% of their commissions to really do what's right by you as a fiduciary. That's not really exciting for most people. So don't be surprised if you've never seen this before, because most advisors don't want to do this, period. But there's a death benefit. There has to be. You're paying the cost of life insurance rather than taxes. That's why it's tax-free growth. And your account right here, your accumulation value, even after 1 year of growth, because this is end of year 1, the way this works, is worth less than you put in. That's very normal for life insurance. Life insurance starts terribly and then gets better and better and better if it's been set up properly. It's kind of like measuring the gas mileage for a flight. I fly back and forth from San Diego to Honolulu, Hawaii all the time, sometimes 24 times a year. If we were to measure the gas mileage when I was off the ground, 5 miles out from the San Diego airport, the gas mileage would be terrible. It takes a lot of gas to get that plane off the ground. But if you measure the gas mileage when we land in Honolulu, measure back to San Diego over the whole time, it averages out to, fine, enough for the airlines to make their money. Same thing with insurance. We don't measure it in the first year or the first 2 years where you've put in 50,000 twice, so there's 100 grand in there and it's only worth 90. And if you cancel, it's even worse. Look at these penalties. Now, are they being boogers? No, they're not being boogers. Insurance companies have to pay money out of their pocket to get your money. I don't know where the statistic came from, but I think it's something like to get $100,000 of premium from a customer costs them around $114,000 to $117,000. They need the money long term, and they're typically going to put the money into 10-year bonds and things like that, where they need to hold it for 10 years. So there's surrender penalties like there is with CDs. I'm going to show you how to make these way lower and how to really put yourself in a safe position. But before optimization, so I would call this a good policy, not a great policy. And I'm not talking about the company or their product. I'm talking about the design. Lower rate of return. Lower surrender value and lower accumulation value in the beginning years. And that's just pretty normal. You put in $250,000 5 years later. You could walk away with the $254 if you've had the illustrated growth. If you surrender, you get less. That goes away somewhere in year 10, basically. But what I really want to show you, because this is just accumulation, accumulation, accumulation. We go from 250 over here. Now we're illustrating at less than it actually earns. There's a law that came out that says we cannot show actual earnings. They have done better than this, but we are not allowed to show that anymore. Even at the piece, or even at the rate we're allowed to show, we would have taken $250,000, turned it into, doubled it in 17 years, 20 years, we're at 658. But there is something that the advisor who showed you this video will do for you. It's a tool that they have, whether they know it or not. They probably do if they're working with me. There's a move that they can make to take exactly the same product. Now focus right here. Focus on surrender value and accumulation value as they go back and forth. A poorly designed product worth 43 and 18. We can just hand this to you. Literally, your advisor can just hand you liquidity or hand you money by having less expenses inside the policy. Everything's the same. $250,000, but it's worth way more. Now let's focus right here. 265, 260. In the old policy or a poor design, it was 254 and 228. 228 versus 260. I mean, you could walk away, even though there's penalties, you could walk away in 5 years with more than you put in. Now we're talking. For life insurance, which is a vehicle that's terrible in the early years and then gets incredibly, gets better over time, that's really good. If you can get these expenses down, it changes everything. The growth isn't that much different in the later years with today's products. There used to be an older product from one company where the growth was tremendously different. But the growth is fairly similar, but you get a little bit more death benefit, $600,000 instead of $550,000. I had to put it in there. I've done so many of these, I've learned you have to raise the death benefit or you can't put all the money in. But we basically have tax-free growth with very low expenses, no taxes due whatsoever, no losses, and just gains. Because why there are no losses? Because it's indexed. When the market goes up, you get the first, in this particular design, it's 17%. Some of them are 11.5%, some are 12%. But you're getting some of the ups, a nice big portion of the ups, and none of the losses. Now let me scroll through the illustration, and we'll find some interesting things to look at. I definitely want to show you a report that you need to make your advisor run for you, or else you cannot hold them accountable. Oh, what do I want to look at here? This is pretty good looking at. So in this particular product, historical compound average return. Compound, not baloney math like the stockbrokers and the joker brokers use. When you don't go below zero, you truly are earning compound interest. When you go below zero, you go up and down all over the place, and it averages 8%. You don't know if you're earning that or not. And I'll actually show you that in a minute. The 10-year compound return, 7.06. Look at the 27-year return. If you went back 27 years ago, bought this product, let the market bounce around, protected your assets when the market went down and just made zero. When the market went up, you get the first 17% in this product. In a safe tool where no taxes are due, you would have averaged compounding almost 9. That's going to be better than the stock. Well, I'm not allowed to say that. In my opinion, having all of your money in this red line when you're in your 50s, 60s, 70s, and 80s, wherever you are, pre-retirement and retirement, should you have 100% of your money in stocks at your age? Everybody says no, unless they're 18, right? Should all of your money be bouncing around where we don't know where the market's going to go as somebody charges you a fee for you to take all the risk? Well, the answer is no. Well, where do we put the safe money? Do we put it in bonds like our parents used to do? Not really, because bonds aren't doing their job. They're not making 4 to 6% safely right now. They're not going different directions as stocks do. In this crash right here, everything went down. Bonds and stocks went down together. What? What do we do now? They're not paying 4 to 6. They're dropping with stocks. And then guess what hurts bond values? When interest rates go up. Interest rates have been dropping for over a decade. Now, April 2017, as I record this, interest rates just went up one time and are probably going to creep up. At least that's a probable thing that might happen that we need to protect against. That would hurt your bonds if you're holding bonds. So there's a report that I need you to know about. The report's called Internal Rate of Return. If you're going to use this tool, if you have non-qualified money, you just sold a house, you have brokerage accounts or money in the bank because you just don't know what to do with it, and you don't want to put it in the market, any type of non-IRA, non-401k, non-qualified plan money. If you have that type of money, This strategy is fantastic. It does incredible things when set up properly. Now, how do you hold somebody accountable for setting it up properly? One, you can go watch my video called the 6 Ways to Improve Your Cash Value Life Insurance right there on YouTube. But you can also learn this. You request, every time someone gives you an illustration, you request an internal rate of return report. What does internal rate of return mean? It's a fancy way for saying what you net after expenses. What do you get to keep? You cannot say to somebody, I have a rental property and I am making $5,000 a month. If they're paying rent of $5,000 a month, you have to subtract mortgage, taxes, repairs, blah, 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 blah. You have to subtract homeowners association. What are you netting from your rental properties? That's what you look at to see what you're making as a rate of return. We need to know not whether you're making 7, 8, 9% in this thing, but after all the expenses for the life insurance. Remember, the entire strategy from E.F. Hutton until now was buy life insurance, but don't buy very much. Put a ton of money into it. It's called a maximum funded minimum death benefit, and then I added minimum commissions because it makes your life amazing, life insurance policy. So internal rate of return is what you're keeping after all costs. Now, important, there are only 2 things that can happen in a life insurance policy. You die, here's the death benefit internal rate of return, or you live and at some point cancel the policy. So most people don't cancel, they just die at some point, and then there's a return for the family. But if you're living off of it, or you walk away later on in 10 years, we find something better, it's important to see what you are earning. What you need to look for on an internal rate of return report that you're going to have to make your agent, they don't want to run these. I mean, if you do this on a brand name product, something you've seen on TV or something you're used to, some brand name product. If you do this, these numbers, I'm not kidding. If you make them show you this, these numbers are going to be 0 to 1, maybe 2 to 3. They're going to be horrible. That's why there's so much information on the internet about how bad life insurance is as an investment. Well, it's bad if you build it incorrectly. It's like saying food is bad. No, it's not. Bad food is bad. Good food is awesome sauce, right? So let's take a look at it. Death benefit, don't worry about that, because if you die, it's always a great return. It's tax-free money. You can't do worse than 4 or 5, it looks like, in this product. We're looking at it as a cash accumulation vehicle. Okay, you put in $50,000 first year. If you cancel and walk away, it's you only get $41,000 basically, $40,000 plus $488. Okay, so if you cancel and walk away, which you have full control over, you lost 19%. It's a negative 19%. Well, that makes sense. Just don't cancel. You are 100% in control of making this a bad investment whenever you want to by walking away. In a properly built financial plan, if you set up your in-case accounts, your income accounts, you've purchased a pension paycheck, and you have leftover money, and you're doing this with the leftover money, which is called your in-crease accounts, you're fine. You don't need to cancel. You got all kinds of liquidity, all kinds of income to pay bills. You're totally fine. Now, this is a retroactive rate of return. So we come out to year 6. It does not mean that year your account made 2.51 and next year it made 3.19. This number says it is as if you've been compounding at 2.51 every year for the whole 6 years. Yes, if you cancel in the early years, you lose money because it's like an airplane, using a lot of gas to take off. That's fine. Doesn't surprise anybody. We all know that going in. We do not use life insurance as a short-term investment tool, at least not this design. But by year 7, it's as if we've been making 3.2 basically. Year 10, 4.17. Remember, if you die, your family gets the equivalent of 7.19%. So it's fine. It's not going to be a bad quote investment, which we're really not even allowed to call an investment. It's not going to be a bad result or cash accumulation tool if you die. But this, if you live, it just gets better and better and better because the expenses are going down, 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 which I'll teach in another video. So if you're using this, now I used a 65-year-old. You really can't be too old for this unless you don't qualify for life insurance, unless you're uninsurable, and there's other designs that may work. But if you're uninsurable, you don't use this strategy. But you can put a surrogate as the life that you're insuring. You don't have to put on your life. You can take it out on your wife, where you put the money in. Take it out on your wife. If you own it, you get the growth. Sometimes you can do it on kids. Sometimes you can do it on brothers who are going to take care of you. There has to be an insurable interest. But forget all that blah, 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 blah. Look at this. The internal rate of return after all expenses where you're paying for the life insurance is in the fives, and let's go into, say you live past or into life expectancy into your kind of 80s and 90s, it's in the sixes. 6% tax-free returns with no losses and no taxes due, no losses, and a death benefit if you pass away beats the stock market over lots of time frames and certainly does what bonds used to do. Okay, so let's do a little bit of a review here and go back to the perfect investment. I think I have it in here. Yeah, so we go back to the perfect investment. When you designed or you answered the questions, we did this earlier on, and said, do you want it to have risk? Do you want it to have guarantees, penalties, liquidity? Here's what you said you wanted, all these goodies. I just showed you a tool that's making 5 or 6% tax-free, safely, with no losses when the market goes down, that has everything except for one of them. Look at the difference between what you currently have or the other options for your IN-Crease account money. You could use annuities. You know I'm a fan of annuities for certain types of money. Safe growth inside of qualified plans like IRAs. I'm a huge fan of annuities for pension paychecks because there's nothing else coming anywhere close to doing as good a job of giving you the high income on a small amount of money. But for growth, for non-qualified money for growth, for after-tax dollars, here's some choices you have. None of them come even close to what we're teaching. So let's highlight a couple of other interesting things about this. Which one do I want to talk about first? Let's talk about indexing first. So indexing, I taught in the last video, but I just want you to see when the market goes up, you get some of it. When the market goes down, you don't have any losses. So there's no recovery time. This one goes down for 2 years, goes up for 5. To get back to where you were, you just lost 7 years of compound interest. And then it went down again. It took another 6 years. You lost 13 years of compound interest. We don't do that in these tools. We just keep stair-stepping up. But there's some math which is really important for you to know when you don't let your money go below zero, or if you're thinking of choosing to leave your money where it can go below zero. Risk has been optional for 20 or 30 years. You do not need risking your principal anymore to make 4 to 8%. You can do that in indexed products. Lower returns can give you a higher balance. Lower returns can make you more money than higher returns. Let me just take a moment of silence and let that sit in. Lower returns can make you more money than higher returns. Back to this picture, if this brown line was averaging 6.5, this red line could be averaging 9 or 10, but you have a higher account balance in the brown line than you do in the red line. The only thing that matters, the advisor who gave you this video understands this, knows this, and wants to teach you this. The only thing that matters is you gaining more money. It's your sheep having baby lambs, period. The stock market, the way that the Joker brokers do the math, has some lies because they use what's called average rate of return. They don't use compound annual growth rate or real growth. They use average rate of return. So they do this. They look over here, say, oh, the market went down 22, up 28, up 10, up 4, up 15, up 5, down 37, up blah, 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 blah. They add them all together, divide by the number of years, and say you're making 8.22. But you are not making 8.22. You are not compounding at 8.22, even though every single retirement planning software on the market will show you somehow growing your money as if you are. It's just a complete lie. You will not be compounding at 8.2. That's the mathematical mean, the geometric mean. Add them all together, divide by how many there were. Now, if you don't go below zero, you take a look at this over here. If you make 7, 9, 4, 2, 5, 1, 10, 9, 6, 8, 10 inside of an indexed universal life insurance contract, we'd have a couple of 0 years in here. This is a different tool, but it still proves the same thing. If you don't go below zero, look at this average. You're averaging 6.98 over here. Here you're averaging 8.22, but that does not matter. Average rate of return is a useless number. Both of them started at 100. And where did they end up? This one has $204,000. You doubled your money, making 8.22%, and had a lot of headaches along the way. You had to be able to emotionally tolerate negative 22 and emotionally tolerate negative 37, baby. What? Over here, you didn't have to emotionally tolerate any negatives. You only made 6.98, but look at your average. I'm sorry, look at your balance, look at your account. You got 10% more money over here. People, it's not about making a fake rate of return like the Joker brokers want you to believe so that you leave your money at risk. They just put it in risk with a side of fees. Nothing wrong with stocks, bonds, and mutual funds if you want excitement in your life and you do not care if you lose the money. That's what it's always been good for. What it is not good for is compounding money that you need and can't afford to lose. You can make less returns and end up with more money by just not letting it go below zero. Well, how do you do that? Indexed annuities, indexed universal life insurance, some of the gains, none of the losses in these down years. Just choose not to take the losses. People, if you had clairvoyance, if you were a psychic, you would have sold right here all of your positions and gone to cash. And then at the end of 2000, when it turns to 2001, you go, is it time to buy? No. You'd wait one more year. If you were clairvoyant and psychic, right here, you'd buy the market, and then you'd make your gains. You would sit in cash, keeping your account balance exactly the same if you were a clairvoyant. What happens inside of an indexed universal life policy or an indexed annuity? They wait till the end of the year. They look back and say, did the market go up or down? Oh, it went down. You don't have any losses, but you don't have any gains either. You just stay exactly the same. People, isn't that exactly the same as if you had sold at the top and went to cash and just held steady, waiting for the time to buy, and then you bought in right at the right time and experienced some of the growth? If you were clairvoyant, or you had a clairvoyant advisor in your life who always sold here, bought here, sold here, bought here, sold here, bought here, you would never experience losses because you'd be sitting in cash. But that advisor, if they're that good, they're going to take some of the profits. They're going to charge you something. So you just get some of the gains. They get some of them, you get some of them. This is exactly the same as having a clairvoyant advisor who knows how to time the market, or it's exactly the same as going to cash right before every loss year, buying back in every gain year. You're out of cash, back in the market. You just don't get all the gains. You get some of them, period. That's exactly the way it works. So we do not need to make sky high rates of return. If you can make 5, 6, 7% and not share any of the taxes with the IRS, you can beat stock accounts that are making 8, 9, and 10% because they're not even making that. They're just averaging that, and that is not the same thing. So I talked about indexing and what a difference that can make inside of a tool like this. Now let's talk about what a difference, that picture won't go away, kind of weird. Let's talk about what a difference tax-free makes. Now, I love these reports. I'm kind of a geek. They used to be a lot easier to come by than they are now. But we call this policy versus for funds. So what this does is it takes life insurance cash accumulation and compares it to 4 alternatives. I'm not a huge fan of the way this one is laid out with colors all over the place. I find it confusing, but I want you to understand. So we're going to pretend we have a taxable investment making 7% per year, like a brokerage account. Not an IRA, but a brokerage account making, actually this is probably an IRA making 7% every single year. Now I just showed you, you're not going to make 7% compound every single year, but even if you could, this is going to show you running out of money. A CD at 2, a tax deferred account, maybe that's like an annuity at 4%, something like that. We're assuming a marginal tax bracket. I'm not going to teach marginal versus effective, but 31 is not a high assumption for a lot of people in the United States to be at a marginal federal plus state for the top dollars they earn. And then we're going to show 1 life insurance policy. I'm not promoting this company. They just have this report available to me and it's useful. So we're going to show this policy growing at 7% tax-free, something else growing at 7, a real 7, which doesn't happen in the market, a real 2, and a real 4. And you're going to see exactly what I taught you before, which is that life insurance starts slow and then beats everything later on. I shouldn't say everything because I haven't looked at every investment on the planet, but would beat these 3 investments, and these are hard to find. So this person was putting in $1 million, $200,000 over 5 years to comply with IRS guidelines so that it's tax-free. So let's look at this investment at 7%. He puts in 209 after the first year. I'm sorry, he puts in 200 after the first year. He's at 209. After year 5, he's up to 1.1 million. Woo! He's always got more than he's invested. That's comfortable. Yay. The investment at 2%. right? Because there's no expenses. Well, there should be expenses in there. Maybe there are, maybe there aren't. He's got 2. Compound, he's got $1 million. How about the investment at 4%? 205. Look at these accounts are awesome. Now, this policy wasn't set up with my tricks. It wasn't set up the right way, in my opinion. So the surrender value is very low. But hey, why not teach this? It still ends up beating the other ones. You put $200,000 into life insurance at the end of a year of making 7%. You only have $178,000 working for you, and if you cancel, there's only $61,000. Boo, boo, life insurance is a terrible investment. Boo. Calm down, calm down. Just be patient. At the end of 5 years, this thing is still not worth the money you put in at the end of 5 years. That is not good or bad, people. This is a choice that you make to have accounts that look good in the early years and then hurt you later, or to be patient and wise and have accounts that don't look good in the beginning and then do exactly what you want later on. Our numbers don't look that good in the beginning, but because it's tax-free distributions, and this is the point, folks, if you're leaving money that you're never going to touch, never going to take income out of, and you want to transfer as much as possible with great tax benefits, you can use life insurance to do that. If you're trying to grow money that you're going to take income from, or you need to take distributions out of, either for just medical expenses and travel or steady distributions, life insurance, another design, does that really well because there's no taxes due on the distribution. So watch what happens. In every account, if you're going to take out $105,000 per year, these accounts that are taxable, you have to take out, $140,000, $150,000, $160,000 just to net the 105. So we're taking taxes into consideration, saying what would you have to take out of the balance of each account to net exactly the same income as this slow starter, non-sexy, bad-looking, quote, investment. It's not an investment, it's a cash accumulation vehicle. This policy that doesn't look so hot in the early years, so the joker brokers use that to talk bad about it. But this is all about taking money out. The best investment is the one that gives you the most money out or lasts the longest when you need it. So if each of these you were to take out exactly the same amount of money to net 105, well, certainly the 2% CD is out of money in your early 80s. Boo, that didn't go very well. Okay, the 4% investment, the tax-deferred one, out of money before life expectancy. Boo, and you know this. I taught this in In-Crease Accounts Part 1. When you get down here and there's $226,000 or $326 or $423, you are not going to continue taking out $105,000 and hope to die in time. You will not do this. Even though inflation is going up and you need to be taking out more, you will punish yourself and live a subpar retirement because you don't like that the account is going down and you don't know when you're going to die. You will lower that 105 to $60,000, $70,000, $80,000, $90,000. You'll stop taking the cruises, stop visiting the grandkids. That emotional decision that everybody chooses to make because they don't know when they're going to die and they have a decreasing account is one of the biggest problems in retirement today. You need guaranteed income from annuities or tax-free income where your balance is not disappearing because you have to take out so much more and pay taxes. This one here runs out early 80s. This runs out mid 80s. If you could truly make a compounding real rate of return of 7, this would last a little bit longer. I don't know where you can make that besides life insurance or annuities. So maybe this is an annuity. Maybe we just call it an annuity. How does it compare to annuity? That's fine. So you come down here, you get into your early 90s, which many, many people are living into their 90s now. You'll be punishing yourself in these later years and not taking out the 105, but it runs out of money. This one, we're still taking out $105,000 when you're 99 years old and the thing's actually growing. The account's going back up to $813,000 because of a unique feature inside of life insurance that you're borrowing the company's money at a lower rate than your money's earning. You're actually making a profit if you live long enough on something called arbitrage. So, this I'm showing one other option that you didn't have with the qualified money. With the qualified money, with my whiteboard, and this picture's still just not going to go away from me. There it is. All right, so we had all these options for your IRA accounts. We had all these options. You could stick it in the bank, choose not to earn a rate of return, not keep up with inflation. Not a great choice. Just don't need to do that. Even for in-case accounts, our clients made 5 to 11% last year because it was an up year on liquid money. So you just don't need these. They're not looking good right now. risk it in the market, just like the picture I just showed. Let yourself have all kinds of losses and headaches and fear and just emotions and 13 years of no growth. Who knows if that's going to happen again? You could do that and try to, average 8.22, which who knows what your balance is going to be. We don't know that you're going to make more money. Or you could do, growth annuities, or you could do this tax-free growth for some of your money. Would it make sense to put it somewhere where it can make 5 or 6 completely tax-free without experiencing losses? Yeah, it does. Okay, let's look at 2 or 3 more really important things, and then I'll go ahead and wrap up this series on in-Crease accounts. Let me get rid of all this from the screen. I'm going to teach you something that I have taught, probably thousands of people at this point, and you just need to understand this. You do not need growth to grow your money. If you leave all of your money in the market, risk with a side of fees where somebody's being paid to go gamble for you. I don't have anything against that. I do that. I have a Series 65 license. I manage money. I have 401ks with 41 people that I manage. I'm not against it. I'm against the misuse of any tool, and so is the advisor who gave you this video, where they would never share information like this with you. They're not going to try to jam you into overpriced mutual funds and share information like this with you that shows you the truth. You should not just be doing that one thing. If you are, you're saying, I need growth or I don't make money. Well, we don't know if the market's going to grow as the baby boomers retire at $10,000 a day and take their money out of the market. We don't know that. But you don't need growth to make money. You need the market to bounce around. So pretend with me for a minute that the S&P 500 is at 2,000. At the recording of this, it's at like 2,300. But there's a score they give it. You can look it up on Yahoo Finance or whatever. Pretend in year 1 it's at 2,000, and then you buy into a bunch of indexed annuities, a bunch of index universal life insurance. You put your qualified money into annuities, you put your non-qualified money into life insurance, like I've been teaching in these videos. And you're like, I love it, man. I want the growth where I never lose money on the way down, and I just stay flat, but I'm stair-stepping up. It's going to be wonderful. Everything's going to be great. And then the market just crashes the first year, goes from 2,000 to 1,000. Okay. It doesn't really matter. That's a 50% loss, right? So if you have your money in the market, that's going to hurt like crazy. But for you, in these tools, it would just be 1 year at 0%. That's awesome, okay? Your account would be exactly the same size. Now, the next year, say there's a small recovery down here, just a little bit of boop, just jumps up like that and goes up to, 100, 1,200. So the S&P is at 1,200. Nowhere near a recovery. It's not back up to 2,000. If you had this much money and you left it in the market and you let it drop and there's 1 year of recovery, what does that look like? It looks like drop, here's that 1 year. We're nowhere back up here. Drop, 1 year. We're nowhere back up here. It happens like that all the time. If that happens and you let your money go down, you're not happy yet. For us, we lose nothing. And then this year, the way it's measured, and you've got to get this, you go 1 year at a time, annual reset every year. It is so important. You start the year at 1,000, end the year at 1,200. The insurance company looks at it and says, well, that's a 20% increase. And you get whatever portion of that you can get. 6%, 11.5%, 17%. You get whatever it is. Let's say you only got 11. It was an insurance contract and you got 11. So over a 2-year period, you made 0 and then 11. Already, we're averaging 5.5 per year before expenses, which can be kept very low, or in annuities, they are 0. So if that's the case, all we need is for it to bounce around, right? The market literally, let me get rid of this, the market could literally go nowhere for the rest of your life. I was looking for a whole clear screen and I couldn't find it. So the market could do this for the rest of your life. Oops. And go nowhere. And you'd make money, because down you don't lose, up you make money. Down you don't lose, up you make money. Or it can trend down for the rest of your life and you can make money, or it can go up for the rest of your life and you make money. In stocks, bonds, and mutual funds, it has to go up or you're not making money, unless you know how to time it and short the market and things like that, which most people don't do very well. So naturally, if that's the case, if in the very beginning of my career, they said, okay, when the market goes down, you make money. When the market goes down, your clients don't lose anything. When it goes up, they make money. I want to know, how often is it down and how often is it up? Now, by the way, you can do your own research on this. You can just go to, go here, you go, Yahoo Finance. Boom. You go to Yahoo Finance, you click in here, you go, okay, what do we got? S&P 500. Let's pick this one, S&P 500. Once that comes up somewhere, they change it all the time, but here's historical data. Go to historical data. You can look this up in any way you want to, but just go back, to 1950 or whatever and look at yearly ups and downs. Do whatever you want to. You just get the data. I had somebody compile this for me because I just wanted to look at it, not necessarily build it. So we went back to 1950, and last time I think I put an update in here was 2015. This thing had taught me what I needed to know a long time ago. So I look at this and go, okay, how many years are up and how many years are down? Well, green is up in the S&P 500 and orange is down. Now I realize there's a bunch of different time frames. You could do January 1st to January 1st, January 2nd to January 2nd, January 3rd to January. I guess there's 356 different ways to look at it, but I'm just showing a concept here. Okay, the market goes up for 3 years and then it goes down, and then it went up for 3 years and then it went down, and then it went up for a couple years. So out of every 10 years, just scan this. Out of every 10 years, it kind of seems like 6, 7, 8 of them are growth years. Well, that's awesome. Don't lose money in the down years. Make money. So you're making money more years than you're not making money, and there are no losses. Yes, I like it so far. However, a few things showed up that I wasn't looking for that have become very important. Look at this. In 1950, we have 1953, we have 1 year down, then it goes up again. 1 year down, then it goes up again. 1 year up, 1 year up, 1 year up. Let me get it up here for you. 1 year, 1 year up. First time in history, these two right here. These two right here, 73 and 74. The first time the S&P 500 went down 2 years in a row was 24 years later, 1950 to 1974. It is not the norm for the S&P to go down 2 years in a row. The norm is 1 year, 1 year, 1 year. There's a correction, and then it continues to go up. Okay, after 1974, how long did it take? Look at this. Boom, 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 boom. We get all the way out here to 2000. Very unique time frame when the dot-com bubble burst. Actually had 3 years in a row, the way that I'm measuring it. Okay, so that's an important thing for you to realize, is that the market does not normally go down for 5, 6, 7, 8 years in a row. More important to me, and I was not looking for this, but it will jump off the page at you, is that after the down years, those bounces that I just showed you, the bounces where you go like this, the market starts up here, goes down, and then people buy when there's blood in the streets. As a percentage, that is very high. If you just don't lose money in the down years, so there's no recovery, after this first down year, it went up 44. Next down year, went up 36. Next down year, afterwards, went up 28, 18, 20. This is almost 2 in a row. That's not very big right there, but then it did a 10 and a 15. That's fine. 31. 1's no big deal. Then 12 and 25. I like that. 14, 26. 34, 26, 23 people. The moral of the story, can we just be very honest? The moral of the story is don't lose money. Make your money when the market goes back up. Don't go through all these headaches unless, if the market's making you 20% rate of return to go through all this baloney, then great. But it's not giving you more money than the safer alternatives. For years, people told me, oh, you're just an annuity guy. You're just a life insurance guy. I'm like, no. For the first 9 years, I didn't carry a securities license because every single person in the securities industry that I asked to show me their returns was doing worse than me by using risk and fees. And I wasn't using fees, or in life insurance they were very low, and I wasn't using risk. I was using wisdom and efficiency and beating them. That did change. I ended up meeting an amazing money manager who hadn't lost money in 13 years. So when someone begs me to put money, I'll do it, but not very much. Not very much, because like I've shown, let's get back here, like I've shown, For the retiree, the group of people that I write books for, I do podcasts for, and that I represent as a consumer advocate, the type of person that I work with, pre-retiree, retirees, and people nearing the end of life, stocks, bonds, mutual funds, REITs, securities, variable investments, nothing's wrong with them. They just don't do anything that we need well. We don't know what our rate of return, we don't know what the account balance, we don't know how much income we can take out, how long it's going to last. But with annuities and life insurance in combination, remember, pretend the stock market does not exist the way a blind person, the way their hearing gets more acute, their hearing gets better. If you pretend the market is not even an option, say, how would I build a portfolio? You will get better at using these misunderstood tools, and what you will realize, like I have, like the advisor who shared this with you has realized, you can do every single thing someone in retirement needs to get them to retirement and through retirement without the stock market. It is an unnecessary tool, completely 100% unnecessary to have any money in securities. Risk has been optional for 20 or 30 years. You should only be taking risk because you want it, because it's exciting, and you are using money that you can afford to lose after you've set up your in-case accounts, your income accounts, and your IN-Crease accounts. Now, I did 2 videos on purpose because retirement accounts, IRAs, 403bs, 457s, and things like that, you cannot use this tax-free growth strategy. Well, you can. You just have to take money out of those things over 5 years, pay the taxes, get it over with, and then put the money in. But ignore that for a second. There's all kinds of fun things you can do with qualified money. Use it to pay for mortgages and use clean money to go invest like this. Woohoo! Now we're cooking with gas. But that kind of comprehensive planning, I'll have other videos on. But this type of money, this clean money, this after-tax money where you don't have to share it with the IRS, except for maybe on the growth and some tools, you can do magical, magical things with it. Folks, you can make, historically, you can make, if you look at these tools, 6-7% completely tax-free. And just remember, why not finish here? Just remember, you designed this perfect investment and chose everything. This has everything you wanted except for one thing. And sure, I wish it had that, but this comes darn close to your magical perfect investment, or not investment, cash accumulation tool. Sorry, compliance guys. But look at all your other choices. They don't come close at all. So my message to you is, if bonds are not doing their job, if bonds are not giving us 4 to 6%, and you shouldn't have everything in your life in stocks at your age, then what are we going to do? Growth annuities and a properly structured life insurance contract not only can do this, but have been doing this for the advisor you're working with and my clients for decades. They do what they're supposed to do when set up properly. Should some of the money in your life possibly be in indexed annuities or in indexed universal life insurance, so that there's either no fees or low fees, absolutely no losses, and returns that may even give you, even if the returns are lower, I think you can get higher returns than the market because the market uses baloney math. But is it possible that doing this may even give you more money in your account with lower returns, rather than using baloney math, risk, and gambling with fees, and then ending up with less money anyway? I hope the answer is yes, because these tools are very, very useful. Let's go all the way back to where I started the original video, In-Crease Accounts Part 1. I said, what if you're going to build a portfolio without the market? We need some money making 2 to 4, some making 4 to 6, some making 6 to 8. This used to be cash on the bottom here, and then this used to be bonds, and this used to be securities or stocks. And they say, as you got older, you need to put more money down here and less money up top. Well, guess what? Bonds and cash aren't paying that anymore. What replaces cash and bonds? Go back to the In-Case Accounts video and look up modified endowment contracts. I'll show you how my clients made 5 to 11%. So the advisor you're working with, our clients are making more money on their cash than a lot of people are making in their risk portfolios, depending on the year. and there's no downside risk and no penalty to quit. Well, that's taken care of down here now. Let's change colors. That's taken care of down here. Make it green because it's good. Bonds aren't doing this, but I've shown in these videos that annuities and life insurance are. Up here, life insurance is doing this, making 6 to 8 in the market and paying the government taxes or paying the IRS taxes. Why not just make 5 or 6 and not pay taxes, people? I hope this is really, really helpful for you. It's going to end the series on the retirement plan that never fails. Take your nest egg, divide it into in-case, income, increase, how much goes in each, and then work with the advisor who gave you this video to pick the best tool for each one of those.